Have you ever wondered how much the falling rupee affects your investment returns? Most investors compare the Nifty and the S&P 500 just by looking at the raw return numbers. But that's incomplete, because if you're an Indian investor putting money into U.S. markets, currency depreciation could be your biggest hidden ally. Let's break this down with hard numbers, real data, and a surprising insight that might just change how you allocate your portfolio. Let's start with the big picture. On 31st July 2010, one US dollar cost around 46 rupees, 43 paise. Fast forward 15 years to 31st July 2025, and that same dollar costs 87 rupees and 62 paise. This means the rupee has depreciated by nearly 89% against the dollar over this period. This shift alone has massive implications for your investment returns, especially if you're comparing Indian assets with global ones like the S&P 500 or NASDAQ. Let's see how. From 2010 to 2025, the Nifty 50 delivered a compound annual growth rate of about 12.4%. The S&P 500, tracked by SPY, gave 13.46%, while NASDAQ 100 through QQQ returned 19.04%. At first glance, these look like modest wins for the US. But here's the catch. These are local currency returns. What matters to you as an Indian investor is how these returns look after converting back to rupees. And that's where currency depreciation flips the game. All right, now comes the heart of the video. Let's say you invested 1 lakh rupees on July 31st, 2010. You had three options. Put it in the Nifty 50 Total Returns Index, a proxy to track the Indian stock market, or convert that money into dollars and invest in SPY, an exchange-traded fund that mirrors the S&P 500. Or go with the Invesco QQQ exchange-traded fund, which tracks the NASDAQ 100, home to tech giants like Apple, Microsoft, and Amazon. All three started with the exact same 1 lakh rupees. Now look at what happened over 15 years. Your investment in the Nifty grew steadily at a 12.4% compound annual growth rate and became around 5.77 lakh rupees by 2025. That's a total return of 477%. Not bad, right? But here's where the story changes. That same 1 lakh rupees, if converted to dollars and invested in SP 500 ETF, became 12.5 lakh rupees. That's more than double the Nifty result. And with the QQQ, the NASDAQ 100 ETF, your 1 lakh ballooned into a whopping 25.7 lakh. This means your total return was 1,154% for SPY, 2,477% for QQQ compared to just 477% for Nifty. So what's going on here? It's not just that US markets perform better. There's another force at play. The hidden hero or villain, depending on how you look at it, currency depreciation. Between 2010 and 2025, the Indian rupee weakened by nearly 89% against the US dollar. This means every dollar you earn from your US investments bought you a lot more rupees in 2025 than it did in 2010. This currency movement amplified your returns when you brought the money back to India. We call this the FX boost or currency-driven alpha. Let's break that down. SPY, the S&P 500 ETFs, raw dollar return gave you 13.46% CAGR. After adjusting for the rupee's fall, your rupee return becomes 18.37% CAGR. So the FX boost alone added about 5.97 percentage points. For QQQ, the NASDAQ 100 ETF, the effect is even stronger. The original dollar CAGR was 19.04%. But after adjusting for INR depreciation, the rupee CAGR jumps to 24.19%. So your FX-driven boost is 5.15 percentage points. This is massive over a 15-year compounding period. In fact, if you compare these final results to Nifty, here's the gap. SPY gave you 5.97% more CAGR than Nifty, thanks to the depreciation of the Indian rupee. QQQ gave you 11.79% more CAGR than Nifty, again largely due to the depreciation of the Indian rupee. These aren't small differences. Over 15 years, they create a wealth gap of lakhs of rupees from the same starting point. So what does all this tell us? When you invest globally, you're not just betting on companies, you're also riding the currency. And over long horizons, that currency effect can quietly become one of the most powerful drivers of return. But let's be clear, just because the rupee depreciated in the past doesn't mean it will continue at the same pace. Past performance is not a promise of future outcomes. Still, understanding where returns really come from, markets, currencies, compounding, gives you an edge most investors overlook. This isn't about abandoning India. It's about seeing the full picture. Because in investing, it's not just what you earn, it's what you understand that sets you apart. Thanks for watching. Stay thoughtful. Stay global. Hey.